So I'm still long-term bullish, and I wouldn't say I'm big on crypto in general. I tend to be pretty skeptical of the majority of the crypto space. For me, it's so far been really Bitcoin and stablecoins that I think are the most interesting, and then there's little pockets elsewhere that are kind of also kind of interesting. But for the most part, it's pretty concentrated. I'm long-term bullish on Bitcoin still. Nothing's really changed with that thesis.
In a recent interview on the Prof G Show with Lyn Alden, we explore the impact of upcoming rate-cutting cycles on investors, the potential for emerging markets to outperform, and the evolving landscape of Bitcoin amid global liquidity changes. At the time of the discussion, Bitcoin was trading around $59,000, reflecting a 3% increase in the last 24 hours and a 10% increase over the past 7 days. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
The way that I'm interpreting this year is that the ETFs pulled forward a lot of excitement. People started to get really bullish in like February and March of this year. And we've seen kind of a slow draining of these kind of overinflated expectations since then. The big metrics that that Bitcoin tends to track, and actually I've commissioned a report from an analyst I like, and I'm advising it that we're kind of quantifying this a little bit more. But Bitcoin tracks global liquidity better than any other major asset class, so better than stocks, better than gold, better than emerging markets, better than bonds. And there's different ways to measure global liquidity. In that report and in general, I define it as global broad money supply, but denominated in dollar equivalents. So you get both a credit expansion or credit contraction component, and then you get that strength of that dollar relative to the other major currencies. And basically, if that goes up or down in a given 12-month period, Bitcoin has the highest likelihood of other assets to do the same direction, which is over 80% in Bitcoin's case. So I put a lot of that focusing on global liquidity when I'm thinking about, say, a 2-year or 12-month Bitcoin price. I don't really try to judge like month by month or quarter by quarter Bitcoin price. For the political component, obviously most Bitcoin conferences are not that political. This particular one that happened in Nashville is it's the biggest one in the world, and it's during American election season. So this one was very political. I guess the interesting thing about it is that most of the headlines were the Republicans there. So obviously Trump was there. There are a number of senators and representatives that were there. But I think what went under the radar is that there were some Democratic politicians there as well, like Ro Khanna, for example. And then he and over a dozen other congressmen wrote a letter to the DNC saying that they need to embrace that industry a little bit better than they have. So right now, if you look at, there's actually a study recently by Troy Cross, a professor, and another professor, I can't remember his name, but they found that they kind of looked at a sample, pretty big sample, it was a well-designed test as far as I could tell. And they wanted to see if there was difference between Bitcoin holders and the general public on a number of metrics, including politics. And they actually didn't find that much difference.
Really?
Yeah, the two biggest areas that stood out were Bitcoin holders skewed male and they skewed younger, but they didn't skew left or right, which was actually kind of surprising because when you look at politicians that embrace it, it certainly has skewed right. The area that I'm more wondering about on the optimistic side is foreign equities. Basically, there's been huge long period of U.S. outperformance, strong dollar environment, strong U.S. equities. Some of that's fundamental, some of that's valuation. A lot of it's capital flows. And one of the few periods where you get a chance for rotation into international markets is during rate cutting cycles. And really, you need two variables to be in place. So one, you need to have a situation where a lot of capital is already stuffed into U.S. markets. And so, for example, in the year 2000, there was a lot of global capital stuffed into U.S. markets. The 90s were a big period of U.S. outperformance. And so the rate cutting cycle that followed that was very good for international markets as some of that capital dispersed back elsewhere. So those two variables were present. In 2008, the rate cutting cycle happened, but there was not a lot of global capital stuffed into U.S. markets. The whole 2000s decade, after that dot-com bubble, was all like the BRICS decade. So global capital was already kind of dispersed, and so rate cutting cycle in the U.S. did not really feed that. The next rate cutting cycle was the 2019 rate cutting cycle. And that was a situation again where it was more like 2000 in the sense that a lot of global capital was stuffed into US markets. And so that was an opportunity for potentially some of that capital dispersing. But then when you had COVID, lockdowns, all the stuff we experienced, that kind of disrupted what could have maybe otherwise happened. We don't really know the counterfactual. Plus, it was the continued outperformance of the handful of top tech stocks. So I would say that this upcoming rate cycle is the first major one in at least 5 years where you have both variables present, a rate cutting cycle at a time when a lot of a lot of global capital is stuffed into U.S. equity markets. And so the rate cuts could be fairly beneficial for some degree of international equities.
As we've just heard, Lyn Alden discussed her long-term bullish view on Bitcoin and its interaction with global liquidity. Now let's delve into her insights on the upcoming rate-cutting cycle and its potential market effects. Alden explores how these anticipated rate cuts might not have the expected impact on refinancing and the broader economy, and emphasizes why investors should closely monitor global capital flows. She outlines the conditions that could lead to emerging markets outperforming and what this means for your investment strategy. Understanding these dynamics is essential for navigating the financial landscape in the coming years. Let's hear more from Lyn Alden.
I'm looking for this potential emerging market rotation. I want to see if we get follow through with it. I wouldn't layer on more risk until you start to see more follow through. But basically, I think this could be like a 3 to 5 year period where the S&P 500 stops outperforming some of these places. The S&P 500 already stopped outperforming Latin America for the past 2.5 years, at least on a total return basis. Maybe we go back to outperforming, but at least so far that's a trend that's kind of been paused. The biggest kind of Boolean outcome is China right now, just because the stocks are so cheap, the fundamentals keep getting better in many cases. But then you have to kind of weigh that tail risk, right? So what is the chance that you wake up to some headline 3 years from now and you get kind of zeroed out of your positions or something? The interesting thing is that if anything like that happens, I mean, stocks like Nvidia are in big trouble potentially. I mean, that they make all their chips in Taiwan. Apple would be in big trouble. Tesla would be in big trouble. So on one hand, investors are very much fine with Chinese Chinese-U.S. geopolitical relations because they're fine with really big U.S. tech stocks that have a presence there. But then nobody wants to touch Chinese stocks with a 10-foot pole, which I would say, high probability they outperform in the next 3 to 5 years. But then you have to tweak that with the tail risk of, what if something crazy happens? So Tesla, I'm not very bullish on fundamentally. Right now, their growth metrics are not great. I generally view them as structurally overvalued. Apple, less extreme case, but basically I would say it's a value stock, a very high quality value stock priced like a growth stock. So you pay, it's not like Costco, but you're paying pretty high valuations for a company that's it's a lot of the growth now is coming from a fairly static top line, and then they buy back their own shares, they adjust their price with inflation. Like you're kind of this like wide moat but slower growing entity now. Doesn't excite me. Meta is more borderline. I've been back and forth on that. There are periods of time where I've owned it. That one I'm kind of more neutral on. Like that could go either way for me. Whereas a lot of the other Mag 7, I think they have reasonable valuations relative to their current and expected growth rates. So the way that I approach portfolio in this environment is a 3-pillar portfolio. So it's like one big part stocks, one part those more kind of like cash or short duration bonds and things like that, and then one chunk is that little more inflationary thing. So energy producers or gold, Bitcoin, things like that. I mean, another thing that's outperformed the S&P 500 for a while is the S&P 500 has underperformed gold since late 2021. not by a lot, but basically if you look at kind of the S&P 500 to gold ratio over the past century, you get these really big sine waves. And if you include dividends, the S&P 500 is greatly outperformed. But it goes through these like 5+ year periods where it greatly underperforms. And there's kind of current signs of a rollover, like that we're in one of those down periods where the S&P 500 does not outperform gold. And I think of gold anyway more like a bond replacement, or if I have a 60/40 portfolio, maybe I take 10% of it and put it into gold, or 5% of it and put it in gold. And so I think that my approach generally is rather diversified portfolios so that you can focus your attention on what you do best.
Lyn Alden examines the effects of shifts in monetary policy, opportunities in emerging markets, and the future of Bitcoin in a changing economic environment. We'd love to hear your thoughts on a few questions. What do you think the upcoming rate cuts will mean for the markets? Do you view emerging markets as a promising investment opportunity? Share your insights in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.